Okay, it's the end of results season, at least for the banking sector, with SBI's results announcement. The Q3 results season for banking and finance especially is considered formally over. And looking back, there appear to have been more misses than hits. Even the hits have been marked by more of mixed performances of either margins or slippages disappointing, even if loan growth and deposit growth were positive. NBFCs actually have done a tad better vis-a-vis expectations, but then even the mighty Bajaj Finance came in for some solid profit-taking after the numbers because of the lower ROA, the return on assets. So how does one approach the sector here on, and what are the key takeaways from the results season itself? I have with me one of the best in business, Santanu Chakrabarti, the banking expert from BNP Paribas. Shantanu, good morning. Thank you very much. First things first, SBI loan growth was very good, but everything else was, I think, under the weather. What's your take? Would you still go with that stock?
So, Latha, in SBI, look, along with loan growth, if I look at the margin performance also, quarter on quarter, a 7 basis point drop, where deposits have been repricing at the rate that they have, is not that big a deal. And frankly, nobody's margin estimates were too much higher than this. So even on margins, I would say it is in line. It is slightly weak other income and the exceptionals which has distorted. The exceptionals, even if you ignore, there's a small disappointment because other income was a little lower. But on credit costs, and this seems to be a theme for most, at least larger sized banks, the credit costs, at least for this quarter, has surprised in the positive. And people have been somewhat, willing to take out, draw down upon reserves that they have built in previous COVID times. So SBI follows that theme as well. And I don't think the net interest margin movement of SBI will disappoint too many people.
Okay. Well, actually, this quarter as well, deposits have been hard to come by. Just saw a Shriram Finance advertisement for FDs paying over 9%. Therefore, okay, what will you say as takeaways? First for SBI and then for other banks. SBI would still be a buy, and you think margins won't be harmed much in the coming quarters?
See, the most interesting part to realize in the current situation is what has been harming margins for the banks. By harming, I mean what has led to the moderation. The key point which is leading to the moderation right now is a repricing of their entire FD book, and the fact that the FD book in proportion to total liabilities has been going up. Essentially, that's where it is. Now, if I do some back calculation, back of the hand calculation on the liability structures of most of the banks that have reported, you'll realize most of them would have reached blended FD costs of about 6.8, 6.9%. So with their marginals now running at 7.25, there's not too much incremental repricing.
Fair point.
From here on, sure, when rates get cut, there's another small period of margin fade which can happen. But as you understand, in a falling rate environment, slightly down the line, there'll be more mitigating factors to that initial margin.
Absolutely. Yeah, we will watch out for what the Reserve Bank does to liquidity. If they seem committed to improving it, that perhaps means the worst is over. Okay, what else other than SBI did you like? ICICI price to perfection, would you say?
See, ICICI, we still see some upside to the multiple because unlike some of the other banks, for example, in the context of HDFC, when people are talking about current balance sheets, people take stock of what HDFC used to be earlier. But in the case of ICICI, we have to be fair to the bank. Given the balance sheet structure and the liability strength that are currently there, you cannot really compare it to a mid-2010s ICICI, where there were concerns on balance sheet and news flow around it was not so positive. So today, if I have to think of a sleep well bank where investors do not have to think too much about what quarterly volatility looks like, where the initiative has to be taken by other competitors to beat it, then that privileged position is enjoyed by ICICI. Is that reflected in the multiples? Because now it is a 16 to 17% core ROE bank, which is frankly trading at around the low valuations which HDFC is trading at, maybe at a slight premium. I'm not saying that their final valuations will be the same. I think HDFC will trade at a premium, as I've argued before. But that does not mean that ICICI looks unattractive. In fact,
Oh,
it is our
okay.
second pick within the pecking order.
Okay.
I think
Okay.
the new ICICI needs to be recognized, and in a way, I think even HDFC's re-rating will help ICICI because it will re-rate the whole sector probably upwards. Once people
Is
realize,
HDFC, are you re-rating HDFC Bank now?
see, I mean the trouble. I mean, since our last conversation, Latha, I had the opportunity to speak to investors as well. See, a part of the reputation of a bank like HDFC Bank is that when guidances are met, there's a certain salience which comes with it. And if the multiple of a bank is high, I'm not saying it's high now, but if the ask multiple were to be high, then there's a certain guidance responsibility that comes with it. And time and again, more market participants I spoke to, it's not that people are shaken on the core thesis. It is just that they're a little shaken on the fact that, probably the bank did not guide with enough of a margin of safety, given that it was undergoing a very large transformation. Now, the nature of such kind of a disappointment is that I've seen that go away very, very fast. You'd remember Axis Bank when,
Yeah.
Axis Bank with the new CEO coming in and had a guidance of 18% ROE, and then that did not get achieved. Initially there was a lot of similar kind of noise that I had heard from investors. How do I trust what the management is saying? Not trust in terms of credibility, but trust in terms of being able to rely on the sanctity of a guidance. And over time, if earnings continue to get delivered, if performance comes through, then such a sentimental overhang does not outlast the weight of earnings. And I
Fair
expect
enough.
that to happen.
Okay. Okay. Yeah. Even if there were a slight dip in the banking sector's assets, then suddenly I guess an HDFC Bank re-rating can be on the cards because it has been historically the squeaky clean bank. Yeah, but let me come to the one where squeaky clean is exactly not there at all. Paytm. How do you approach this now? We have now some more clarity. My colleague Ritu Singh even broke the story on how KYC has been wanting, though the management cannot be faulted for any money laundering. It's KYC that's been wanting, and the way in which PAN cards have been used, etc. How do you rate the stock now? Dip into the distress?
I think the broader comment that I would have out here is that it looks like the regulator is very focused on managing systemic risks ever since they have gone down the path of broadening the number of banks, whether they be payment banks or small finance banks, and even in fixing governance structures within banks. I mean, at some point in time, MD approvals were kind of a non-issue. I mean, there was no speculation around who's going to get renewed where and all of that. But now we have seen that, I mean, RBI takes very differentiated calls, very nuanced calls based on, how much rope they want to give to, based on past behavior, or at least their approximation of what past behavior looks like. And from that point of view, I mean, I think all these regulatory actions form a string, which essentially gives you direction that the RBI is happy to use both the carrot and the stick. And I mean, you
Yes.
remember the HDFC banks, new customer credit card issuance was stopped. I mean,
Absolutely.
the Bank of India, right? There are no holy cows as far as the regulator is concerned. And I think in the long run, that will serve the Indian banking industry well.
Okay, okay. So, well, I'm running out of time. So, overall, what are your buys in the NBFC space and banking as well?
So in banking, I mean, the ordering remains the same. It's just, I think that HDFC Bank and ICICI Bank have a lot in them. And Axis Bank, Latha, you would appreciate that since we are now starting to talk about a mid-calendar year set of rate cuts, then, Axis Bank with a relatively higher borrowings proportion, short-term borrowings proportion. will have the fastest repricing of liabilities. So it stands third, partly because we think that the liability side beta benefits in an easing environment is high. And next will come SBI. Everything else follows that. So that's
NBFCs. Yeah.
going.
Okay. I don't have time for the mid caps, but give me one or two NBFCs.
So, for example, AU Small Finance Bank is a name we like. I know the market was fairly disappointed with the numbers they put out, and that disappointment has two parts. One is that market's disappointment with the relatively new credit card business, and markets question marks around the slippages that they have had in their more core part of the business, what used to be their the business that as an NBFC they have thrived on. And all I would say is that we have seen the asset book put through a ringer in the period of COVID. We saw how fast it could bring it back. So I think election overhang kind of thing also. They can come back clearly from. Now, look, I mean, given how cheap some of the large cap stuff is, to make a very pointed
case, yes.
For a mid cap name is hard. But amongst the mid cap names, that's the one we prefer. We really think this is going to be the year of large cap private banks. And most of that performance is probably be in the second year, by the time that the second half of the year, because by the time the market then see 1 year forward, the earnings look absolutely outstanding from the
Got it, Shantanu. I think I'll have to invite you yet again for an NBFC discussion, but this was most helpful. Thank you very much indeed for joining us with your thoughts on the banking sector performance. It's been mixed, but every analyst is betting that the big banks are going to come back, and this will be the year of the big stocks and the big banks. Wrap up on Bazaar. Short past is up.